Hello everyone, my name is Jake and welcome to Growth Academy. If you're new, please consider subscribing for more content like this one. Let's get on with the video. Almost everyone, including Buffett, Dalio, Burry, and ordinary individuals like you and me, believes that huge inflation is on the way. With so much focus on growing consumer prices, many investors have come to the conclusion that inflation is here to stay. Cathie Woord sees an entirely different picture. Recent economic data suggests that inflation is fast slowing and may continue to do so. This video will go into detail on Cathie's contrarian viewpoint and how the U.S. economy is quickly deteriorating. From a wide view, it makes sense for inflation to begin slowing. Stimulus checks are no longer being distributed. The Federal Reserve is beginning to consider tapering as early as this year, and the Delta variant is fast spreading across the United States. Decelerating inflation, sometimes known as disinflation, is reasonable for the reasons stated above. Recent economic data for the month of August also suggests that inflation is on the decline. The most striking recent data was considerably fewer non-farm payrolls. The number of non-farm payrolls indicates the number of workers in the United States, excluding farm workers. Non-farm payrolls are contrasted from month to month or year to year, so that economists can see the labor market strength. Economists predicted that the job market would be quite robust in August. Non-farm payrolls were anticipated to increase by 733,000 in August compared to July. Contrary to predictions, non-farm payrolls grew by just 235,000, a staggering disparity. Economists' estimates are generally wrong, but not by much. This is a significant indication that the economy is beginning to deteriorate. There are numerous possible explanations for this. The two most evident causes are that the chip scarcity is deteriorating and that the Delta variant is rapidly spreading. Both of these variables may have a short-term negative impact on employment figures. Furthermore, there may be a more terrifying element at work, which we will discuss shortly. We can see that both the Delta variation and the chip scarcity are contributing to decreased employment statistics. Another reason that might be at work is that the economy is beginning to deteriorate. Cathie Woord has been warning about a deflationary crisis for a time now, and it appears to be taking effect. Total vehicle sales have fallen from 18.7 million in April to 13.4 million in August, indicating a rapid decline in auto sales. This is due in part to a chip scarcity, but it might also be due to the shift to electric cars. Another element at work is the rising inventory in consumers' houses. Many individuals have already acquired automobiles to escape mass transit during the epidemic. They probably won't need to buy another vehicle for a time. All three of these issues, which include a semiconductor scarcity, electric vehicles, and consumer car inventories, are hurting the entire auto industry. Outside of the car industry, inflation is beginning to moderate. M2, a measure of the entire money supply of the US dollar, is now decelerating significantly. M2 growth has decreased from a year-over-year rate of 27% in February to a year-over-year rate of 12% in August. This may appear to be a significant decrease, but it is simply the beginning of much more to come. The dollar's money supply is still increasing rapidly, but it is also rapidly decelerating. Based on current mood, the money supply is expected to decelerate much further. The infrastructure bill coming in lower than projected might be a trigger for further slowing. Consumers are concerned about rising inflation and rising debt levels in the United States. Because Americans are concerned about inflation, this generates the inverse of a self-fulfilling prophecy. Politicians are now encouraged to direct government expenditure toward inflation, which alone decreases inflation. We can see that one Democratic senator from West Virginia, Joe Manchin, feels that a large infrastructure bill would be disastrous for the economy. Cathie Woord interprets this as a hint that inflation will ease in the short term. All the indications we discussed before are mirrored in the bond market, which does not perceive inflation as a threat. What's more concerning than inflation is deflation. An impending deflationary catastrophe might cause significant economic problems. Low to moderate inflation as a result of reduced interest rates helps innovation, especially when the economy slows. Lower interest rates lead to increased borrowing, which leads to increased spending on future growth. High inflation, on the other hand, would be disastrous for innovation, since higher interest rates reduce the motivation to borrow money. Despite everything we just discussed, Cathie feels that innovative stocks would still outperform if inflation rises, because in her words, innovation solves problems. This may be observed in the growth of cryptocurrencies as a form of inflation hedge. The notion that inflation is likely to increase has recently gained traction. Michael Burry is the most severe example of this, believing that inflation will ruin the whole U.S. economy. Cathie Wood's argument, while going against the grain, makes a lot of logic. All the factors that contributed to excessive inflation in the first place are beginning to moderate. Stimulus payouts are no longer distributed. The auto industry is slowing. Politicians no longer want to spend as much money. Commodities are collapsing, and the labor market, most significantly, is stalling. With that being said, let me know what you guys think below in the comments. As always, if you enjoyed this video, please hit the like button and subscribe, and I'll see you in the next one.